Welcome to the Option Czar service. The Option Wizard is behind the scene. And who is the Option Wizard? It's someone who's very anonymous. Why? Because the Option Wizard is a market maker between the public buyer and the public seller when it comes to trading options. And when do options have the greatest value for a profit? The Option Wizard has spent many calendar years bringing services to institutional hedge fund managers and the private sector. However, we have decided to develop a complete new service for the people who try to trade options all the time, always come in last place. 85% of the call side goes worthless and 85% of the put side goes worthless on a monthly level. This is a 9/16 calendar. It's 1 day after the monthly expiration in September and goes all the way through week 1, week number 2, and not only that, you can see down here week number 3. Week number 4, we have not added the data because we have a monthly options expiration upon us and an earnings season with Apple Computer. However, the main focus of the video is for you to learn why there are great times to be in the call side at the most deflated wholesale price where the public does never want to buy. And in this column here, this is the actual stock price movement in each one of the 5 days. The open, the high, the low, and the close of the equity. The intraday range and trend ratios have to do with the equity price movement. Let us not confuse you with this part of it, but it does ultimately populate the prices. What we would like to clearly define over here is that we have a calendar date of where the options were traded. The high ratio is a ratio that the Option Wizard uses. The low ratio is another Option Wizard tool. The open, the high, the low, or the close of the option is another Option Wizard tool. Closing price to change, close to open, and then the actual volume of the contracts and where the open interest started here. 1 day after it, we had the expiration. 1 day after the expiration, it's clearly evident there was 46,000 contracts open. Then it increased here on the second day in this line item, and the ratio high and the ratio low, you can see the open, you can see where the high of the contract was, you can see where the low of the contract was. And why is it that the public always loves to buy the high of the contract and write them down to the low, or when the low comes into play and it makes the big move, they never make the transaction here? The contract actually closed at $16.30. The closing price change was $6.31 minus 0.99 close to open. So it's obvious that we put the high in the contract and then we made the low. It's obvious in the number. 19,000, we went up in the open interest. As the open interest was peaking here, when this call option on 9/20 was at a ratio high of 100%, the Option Wizard, the one working for you, knew that everybody was in the call side of the contract. And the call side of the contract hits a high of 23.65. What it meant that in the 3rd day of the new calendar month of the monthly expiration that expires on the 3rd Friday of every month, everyone was all in right here. And at this same row that I highlight here, going across here, you can see where the equity was as well. The high was 422.86 on 9/20 and the low was 411. It closed at 413, well off of that first 52-week high. And let us not confuse you with this part of it here. Just know where the equity price was. And there was a significant change at that point in time. In column 1 across here from the far left in here, that when the call was totally inflated at 100%, the Option Wizard knew that when we were put in the high end, that the $410 put had peaked to an all-time inflated high. And it meant that all the buyers were currently in the market. Now, the option wizard knows what the expert floor trader in the option pit can do. He can sell short the contract, and as it loses all its value here, at the very same time that we put in the high on the 410 put, this 410 call was putting in the bottom here. The option wizard knew that at that time $2.11 was on wholesale. Another thing that the option wizard knew ahead of time, the one working for you, is that the calls right here had peaked at 100% at 23.65 in value. Okay, because it did. The open interest went from 46 to 55, and on the third calendar day it hit 60,000 in the contract. The following day on 9/21, 97% inflated call option. Low to ratio was 75. The open was 21. The high was 23, but it closed. The low was 18.20, and it closes on the low. Closing price change was $1.45. The option wizard uses all of these tools because the option wizard built this platform between the retail buyer, the retail seller and buyer, and all market makers and everyone involved. So basically you can clearly see here that the option was losing its value down to 73% on 9/22. Look at the open of the option, 13.95. Look at the call, 17.75. Yeah, they were tradable up there. The public never sells at the high. No, they don't. But the low was a buying opportunity on this day because the low of the option went from 17.75 to 12.40. That's the wholesale bid. So that means that when they were up here at the high, they were riding them down to the lows. And there at that time was 15,649 contracts, and the open interest at that time here, you can see where the value was at 55,000, and you can see where the value here of the open interest was on 9/23. Having said that, the option wizard has a system that is a mathematical system. And why does the public always come up short? Why does the public not understand that at the time that I was putting in the high of 23.65 on the call option, at the very, very, very same time, I was putting in lows and highs in the 410 put. So buying the 410 put over here on 9/20, as it says here, you could have got in on these put options at $10.67, and over a number of days, the put option made a high of the 410 put, made a high of 57.25, and it was a great trade. Why is that? Because at the very same time that this was putting in the lows, we were at that inflated price that you see here. Here is the inflated price. Here is the deflated low and the inflated call side. So when calls get inflated, the public never sells up, and they always go down like that. And it was the silent individual that the option wizard knew to be on the other side of the public transaction, because everybody was falling down with the call and the put side would go up. Now let's take a look at what the option wizard does. You can take a look at those charts as I have shown, and I will show you from 23.65 down to a low. We got to a low down here in this week, $2.11, and that was minus $1.30 from the closing price change, and we were at 0%. That meant that the put side here was inflated. When the call was at 0%, it was inflated. The call was deflated at 0%, and the put side was inflated and would come down, and it was time to buy the call. And what the option wizard does is he gives you these entry orders. And they went from $2.11 to the closing price of Friday. These options closed at $18.20. Now, let me explain what this is. Down here, when the put side, was losing, when the call side was selling off, and I'll be happy to show you what that is in the table. It's clearly evident that the movement was negative open interest of these contracts because the contracts went negative. When we peaked at the bottom, you went from the peak value of 64,000 contracts open interest here. But when it came down, when they were at the lows here at $2.11, there was only 34,000 open interest. What I would like to say to you all very clearly is how these movements started and why. That's what the Option Wizard designed. And we're just giving you a little history as that will improve. And as it improves, what you're going to be taught is that the Option Wizard knows when these great values of imbalance call and put values take place. So when I was putting in the low here at $2.11 on 10/7, that was the low of the contract. Remember that down here they took out $21.54 range, and the equity had a reversal of $68.62 because it did. And the lowest wholesale buy ratio that created an opportunity was at 8.92% or 84%. But here's the thing. I will show you that the call option lost 1,121%. Okay? Because it did in this field. So what I would like to point out clearly is that when the inflated 410 put was up here, this call option that the Option Wizard knows when to buy here and when to sell short up at the high. But the Option Wizard could never accomplish this goal like any professional or non-professional. The Option Wizard is a market maker, and the Option Wizard knows when either side is inflated and both side or the other side is deflated, because there is a very sophisticated mechanical price mechanism, mathematical, that plays into the Option Wizard market maker platform. Now down here you can see performance from high to low was negative 91% in the call, and the equity from that reversal down here, it had a 16.23% correction on the daily chart, which it did. And I can show the daily chart. When we were putting the bottom in, this is when that original call option at 23.65 was at its inflated peak and came straight down and lost 91%. At the very same time, the equity has a $68 correction. And at the very same time over here that this was occurring, you were at the all-time low of the 410 put that we trade. The Option Wizard buys here and sells up here, and when selling up here, the Option Wizard is buying the low deflated value at $2.11. And at the time, we had a $68 correction here. We put the bottoms in 4 days, and then we had a huge breakout, and the put value of the 410 came all the way down, and that call value, so you lost 91% in the calls, which was over at the highs. Here, 91% loss, and a huge, huge gain in the 410 put. The Option Wizard knows when to put you on that side and put you on this side. So basically, once again, you can see where the low of the equity breakout was. This is the 410 put. Once again, this is the 410 call. Once again, the Option Wizard proprietary software that was developed as a market maker is totally different than what the public does. So basically, what we would like to inform you is that it's an overview of how the Option Wizard makes decisions based on decisions that are between the buyer and the seller as a market maker in the option pit. That's not your professional community that tells you when to go buy. All of those models don't work, because what happens in those models, and the option wizard is a market maker, of course he knows. What they do is they get caught in the high of the contract. They don't have a system.